Welcome to the Financing Simplified podcast with Anthony Venuto. If you're looking for answers to your financial questions, let Anthony and his network of friends and associates answer regular questions that regular people have about their money. Thanks for tuning in. It's time to start simplifying your finances.
Welcome back to our Financing Simplified podcast. And this time around, I wanted to get some rapid fire questions, some myth and truth questions, as the current market right now is definitely picking up. We're seeing a lot more home buyers, a lot more pre-approvals, a lot more applications and purchases coming through our desk. And a lot of clients have questions. So I'm going to turn it over to our questionnaire extraordinaire.
Let's do it.
Let's do it, Steph.
All right, very first one. This is it's going to be myth or truth.
Myth or truth?
I have the answer here, but I want to hear it from you. Very first one, we'll start off on the easy note. Myth or truth, having a perfect credit score guarantees the lowest mortgage interest rates.
This is a great question. We get to credit. Credit does determine a few things. Most lenders have a minimum credit score. Okay, so they have a minimum credit score. If it's below that, you're probably going to get denied credit. When it comes to certain lenders in the equity space, so if you're looking at alternative lenders, even private lenders, they base their credit score off of, they base their mortgage rate off of your credit score.
Off of your credit score?
Yes.
Okay. You're absolutely right. So, easy one.
Thanks. Where'd you get those answers?
Next one. Myth or truth, adjustable rate mortgages are always riskier than fixed rate mortgages.
In generality, they are.
Myth or truth?
It's definitely truth. Definitely truth. Just a quick sidebar on that. There's difference as adjustable rate mortgages. The true variable rate mortgage, that's the one where your payments change.
Correct.
With the Bank of Canada, the prime lending rate. Then there's variable rates. Some of them are the ones with the static payment and the trigger rate. So you have to be very cautious on those particular variable rate products.
You're absolutely right. 2 for 2. Third one. This is a very interesting one. It can go either way. It's very subjective. Myth or truth, paying off your mortgage early always saves you money in the long run. Myth or truth?
There's a little bit of both here.
Uh-huh.
A little bit of both, and I'll expand on what I'm saying. Of course, paying off your mortgage early, or as best as you can, will save more money in your pocket because you're not paying interest on it. Simple fact. However, for some individuals, what happens when you're paying off your mortgage? You've worked all your life to pay them on the mortgage, and then all of a sudden you're like, honey, I need to do a renovation. Honey, we want to do this. Now, all of a sudden, you're going back to the bank, potentially to get a line of credit or a new mortgage at a higher rate, and you're paying interest on the money that you used to already pay off the mortgage.
Uh-huh.
And that is sort of that, yes, myth and truth.
So what I see here, it's a myth, because paying off your mortgage early always saves you money in the long run is actually a myth. It's not true. According to these so-called professionals, they say that depending on what your amortization is, depending on what the current going interest rate is, depending on what kind of down payment you had, depending on what kind of size you have, where you live, there's a lot of factors. Again, this is subjective. It's
Paying off your mortgage, or do they mean the penalty to break the mortgage?
No, they don't.
Okay, so I don't get what they're saying in that regard.
That's what I'm saying. It's a very myth and truth.
Mm-hmm.
It depends on how everyone's situation is.
Let's just think about it financially. You if you pay off your mortgage, even if you're paying 1% interest, that's 1% interest that you're not paying
Correct.
to the bank.
Exactly.
You're putting in your pocket. So, I mean,
It's a subjective one. All right. Myth or truth, your down payment is the only upfront cost when securing a mortgage.
That is definitely a myth. Down payment is the biggest part of your closing, right? Is the down payment, whatever the amount, the deposit plus the down payment, whatever it is you're putting down.
It's not the be-all, end-all.
It's not the end all, because then you have to factor in legal fees, land transfer taxes. You need to factor in a whole slew of other things, appraisals, water potability, depending if you have a cottage with a well. There's so many different things that can come into that closing. It's not
So you can comfortably say it's a myth.
Definitely a myth.
Okay. Here's another one. Tricky. I think tricky. Myth or truth. Refinancing is only worth it if you can get a significantly lower interest rate.
That is also a myth because even though you might be paying a little bit more, like in this environment right now, for a mortgage on refinancing from a cheaper rate into a higher rate, the fact is if you're refinancing to pay out debt, that debt can be sitting at 19 to 20% or higher. So you're actually saving money in the long run.
Really?
Mm-hmm. Why? What is the artificial intelligence tell us?
So artificial intelligence is saying that myth. It is a myth because refinancing is only worth it if you can get a significant lower interest rate. Is completely false. There's no, according to what the AI system is saying, there is no weight to that response. There's no weight to it because it all depends what you're refinancing, how much. A lot of factors. There's a lot of factors.
I'm proud to say I'm still smarter than AI.
So far, Anth is up in this game. Myth or truth? You need a 20% down payment to buy a home. You need a 20%.
Myth. You don't need 20%.
I always heard yes, you do.
You want 20% to avoid paying the mortgage default insurance on most mortgages in Canada, but you don't need 20%. You can buy as little in Ontario and Canada. You can buy with as little as 5%, obviously providing you qualify. And there's other stipulations that come with that.
Is there stages? Like you can do 5% from this amount to this amount. Is there such a thing like that?
You're 100% correct. First, $500,000 is at 5%. Anything over that, anything over the $500,000 mark now becomes 10%, up to a maximum purchase price of less than $1 million.
And if it's over $1 million, it must be 20%?
Must have 20%. Must have 20%. You cannot buy with less than 20% down. And
that's law? Like you cannot?
You need 20%.
Interesting.
Yeah. Anything over $1 million.
Really? Okay. We got 3 more. Here we go. Looking good for time. Myth or truth? It's always better to choose a short-term mortgage for lower overall interest costs. It's always better to choose a shorter term mortgage for lower overall interest costs.
That's a myth and a fact. It depends on the interest rate right now. I mean, obviously, if interest rates are lower, generally the consensus was take on the longer term because the interest rate's lower.
Exactly.
But with the volatility with interest rates right now, most clients are opting for a slightly higher rate on a shorter term product because if rates come down, you're not hand tied to that particular term for a longer period of time.
Excellent. And you and AI are very much in sync on that one. So far, all right.
And by the way, I didn't read these questions or answers.
No, this is the way myth or truth with you and me, which I think we should make it a more common occurrence. I will not prompt you. That's not how we do it here. Second to last, get ready for this one. Your pre-approval amount is the same as your home buying budget. That's I don't know. That's a tricky one. Very tricky one. Myth or truth? Your pre-approval amount is the same as your home buying budget. Okay.
So in my brain, I'm trying to word this question or rephrase
Correct.
it. I'm going to dissect this and see exactly how in sync we are. With a mortgage pre-approval, that's just an amount that we are providing based on your criteria, your income, your documentation. Can there be a variance? Absolutely, because it can change depending on the final purchase price of the house. It can change depending on what the property taxes are. If there's maintenance fees on that condo, the amount is not necessarily the exact same. It is close to, but not identical. So what is AI saying?
So AI saying that it's a truth. Your pre-approval amount is the same. It is the same as your home buying budget, and the reason why is because it plays hand in hand according to the financial institutions. Now, again, this may be subjective to your situation. I think a lot of the questions asked by a mortgage broker to a mortgage broker are very subjective. Because everyone's situation is
every situation is unique, Steph, 100%. So, for example, let me add preface to this.
Sure.
The pre-approval amount is determined at the lender's pre-approved rate. So that rate might be higher, slightly higher than the actual contract rate that they get on a live deal. So let's say the rate's 6%, but the actual client might be getting 5.5%. If we're looking at that particular situation, that client might qualify for slightly more, right? But because we have to pre-approve the deal at the bank's requirements, some banks have a hard stop on requirements. For example, they'll use 65% of the value of the property as the assessed property taxes. That might not be the truth on paper, but they factor that in, so that pulls the pre-approval amount down.
Gotcha.
But once we run the numbers as brokers, we're going to say, based on this number, the amount's actually going to be up a little bit more or down a little bit more. So it's not 100% truth. That's just my answer, and I'm sticking to it.
And that's a very well thought answer, and I think you've nailed it. Lastly, the last question of this episode, and it's a tricky one. Let's put myself as the consumer right now. If I wanted to check my credit score, will it be affected if I come to you and ask you to do a credit score check? Or is it the same as me doing it on my own?
Well, yes, the credit check impacts the score overall. There's no particular demerit point system. Let me just put that point in there.
But
we don't know
if you check it.
If we check it, we're considered, and this is the terminology that's in the industry, we're considered still more of a soft check. There was a transition between Beacon Score to FICO, Fair Isaac Newton.
That's right.
But we're a soft pull because we're not the ones lending you the money. The lender's the one that's lending you the money. So generally what happens in the credit pull, we pull Equifax. The lender may pull the opposite on TransUnion, so it doesn't have a double hit. But when we look at that credit score, we're obviously looking at our what's called the broker report or the Equifax report. For a consumer, their actual documentation may look different. It may not have all the details that ours do. Ours are more intricate than the one that the consumer's getting. But as long as it's pulled from one of the two major reporting agencies, whether it be Equifax or TransUnion, it is extremely valuable to the client. Well, actually, with technology today, most clients that have banking apps with major banks, they'll be able to pull their own credit score right from their phone.
Right. But if I check it through the bank or if I check it through you, it will be affected. But what about if I check it on my own?
No, it won't. Unless you're doing a hard pull, like for like what we call a hard pull, which means you're going through Equifax or maybe TransUnion.
Got you. Then yes.
You have free consumer reports, but anytime you're pulling that information, there could be an impact on your credit score. So you have to be very cautious.
Very interesting how I come to you and I want to do a credit score, and regardless, it's going to be affected. Like, it's pretty crazy that all I'm asking you to do is just check it.
This is actually, and I would love to a little bit, we're actually setting up appointments with some of Equifax and TransUnion to sort of understand how they're transitioning, but I think it's very, very important for consumers to do at least once a year. Some of them have credit monitoring agencies that you can hire. You can pay for monthly subscriptions for this because as fraud continues to be a major problem in society, you have to monitor your credit. It's why should a client get penalized if they're just inquiring?
That's right, just inquiry.
But the thing is, the way the credit looks at it is every time you're doing that, it's for a reason, right? So
of course it's for a reason.
I know. This is the thing. It's like, so like we're pulling it, we're pulling it to find out if the client has the ability to borrow.
Correct.
If, like as I said, sometimes clients are looking just to say, hey, what's going on with my credit? And I think through specific apps or through specific agency, it may or may not impact you. I don't know that answer 100%. But whenever a bank or a broker is pulling it, it's because you're applying or you're inquiring about an application for a mortgage or a credit card.
Do I have to pay for this credit check with you?
No. But we do. We pay for it.
You pay for it?
Absolutely.
Very interesting.
I think it's $22 a pull.
Really?
Yeah.
This is very interesting. And last thing to end off this episode, which I think is very intuitive, where does your credit score need to be? Where's that nice, good space?
This is actually a really good question, and we've had this conversation with a lot of people. So as credit systems change from Beacon to FICO, there's more details, how that transacts, what you're looking at in your credit score to maintain a good score. Because the score, as long as if you want to know a number, I would say 680 plus. 700 is perfect, like is where you want to be, starting at 700 to 850 because that's the max with FICO. So why is that important? Why do I say this number? That score is driven by the amount of substance within the credit.
Gotcha.
For example, you could have an 850 credit score with two credit cards at $500 each. does that tell the lender that you're really responsible?
No.
Or does someone who has a 720 beacon score with a car payment, a mortgage, a line of credit, multiple credit, what's better?
But that's not better? That's not better because now all of a sudden you're. No, I get it for credit. Yeah, you're building credit that way, but you're also in debt.
No, I'm not saying that you're in debt. Like, I mean, you have a car payment, you have a mortgage. What I'm saying is the substance within it is basically showcasing how responsible you are, right? Because
wait. Let me challenge you now on the mic. If you have your credit cards almost maxed out, if you have a very high car payment,
that's a different story.
but that's still credit score.
No, because I was saying is you could have. I'm not saying you're maxed out on your car payment. I'm not saying you're maxed out on your credit cards. I'm saying is what's better? 2 trade lines, 2 specific credit cards at a $500 limit that's driving an 850 beacon score.
Okay.
Or someone that has multiple credit cards with huge limits but no balance.
Okay.
Car payment, mortgage, line of credit.
So you tell me what's better?
The person with more substantial items. Because that's showing more responsibility.
More responsibility.
It's showing, look, he has all this credit available to them. They're not using it all, but they're able to maintain it.
So question, wouldn't the best credit to have to your name, other than a credit card, other than a car payment, a home? Wouldn't that be the best credit you have?
Absolutely. Mortgages are a very important part of the credit rating system.
Do they play a part of?
Yes, for some. So there's some banks that do report, some banks that don't report to your credit bureau.
Wow. This is for another episode, man.
Yeah.
So do me a favor now. I got to be that guy. Look at this camera and tell everyone where they can find more information.
Well, if you guys are looking for more information, obviously you can follow us on Instagram at InTouch Mortgages, on X at @A_Venuto. X is the old Twitter. That's
there you go.
I usually call it Twitter. I still call it Twitter.
We're going to go to X.
We're going to go to X. YouTube at Finance Fridays or InTouch Mortgages, at InTouch Mortgages, and obviously our website. And you can feel free to DM us, send us a message if you have any questions and you're looking to get out there into the market.
And we will see them next time.
We will. See you next time.